is a preparation provider for FRM. We are so honored to have Abdul Sohail, who has been working in the risk and regulatory domain for a very long time. So just a brief introduction. Mr. Sohail has been working in risk and regulatory domain for almost 15 years now. He started his career in Karachi from KPMG. Then he moved on to work in KPMG UK. Then he moved to industry and got an experience of working in various leading banks, Society General, in Zuhu, and he's currently working as VP Global Risk at Bank of America. So thank you, Sohail. Thank you for joining in and giving us this opportunity. So if you could just briefly discuss how has been the journey in the last 15 years of starting from Pakistan, Karachi, and then moving on to work in the developed world. How did you find it different, and what has been the experience so far?
Yeah, thank you, Wes, and thank you for giving me the opportunity to join one of your sessions. Yeah, quite interesting. It's been tricky. It's been challenging, to say the least. But that is the nature of the industry we work in, and in fact, any field of life you go into. As you mentioned, I started with KPMG Tasir Hadi in Karachi in 2003. Completed my qualification with them, and then moved on from there on. There is certainly different working environments. There is certainly a difference in that. I would not say that there is a difference in quality or the hard work or the talent that is available in any location, but it's more around the way things are done, I would say, is different. And you can appreciate that being different level of I would say, like today's topic you mentioned, developed world side of the things. But if the countries they're looking to improve, or there is room for improvement and developing at the moment, there's a slight difference in different environment in there. So yeah, it has been challenging, but it's been a great learning process for me as well. At every stage, you need to take risk. Not, it's just coincidence we're talking about risk management today, but in your life you have to take risks, and things, hard work is everything. Things do pan out at the end of the day, but it's all been interesting.
That's true. So I think without wasting further time, let's move on to your presentation. To the participants, you'll be taking some of the questions. So if you have any questions during the session, or if you would like to ask any sort of question regarding your topic or away from topic regarding the risk management journal, please feel free to type in the chat box. So let me just share the screen, and then Sohail, you can continue with it. Yes.
Great, thank you. If you please swipe to slide number 2, in fact, slide number 3 for me, please. We can jump right into the topic. So as you all are aware, we'll be talking about the concept of risk management in the developed world. To begin with, what I would say that there are various kind of types, or approaches people can apply or companies can apply. And there are a couple of aspects that you need to consider as an overall planning or overall framework point of view. And that is internal aspect of the risk management, as well as external aspect of the risk management. And what I mean by that, internal from legal entities point of view, from companies point of view, companies need to consider their internal procedures, policies, and the overall framework, that how will they implement and what is the philosophy of the companies from the risk management point of view. And this is the crux of our today's discussion as well, when we move on to the further detail. The other aspect of the risk management is the external aspect, which is more around what you are or what the company is supposed to do from regulatory requirement point of view. So regulators come in and they have standard sets of rules. There are standard regulatory reporting that needs to be done. Some documents needs to be produced, such as the annual assessments and so on and so forth. And we will be touching upon how or what those things are in UK and European region, and how they are implemented in the legal entities, or legal entities are required to implement those. So on that note, to begin with, I will go in more detail on the internal aspect of the risk management. That is the what a company does to have a strong culture of risk management within the organization. So this is the top half of this slide. So company's risk framework. So what is a risk framework? It's basically a set of rules. It depends on various procedures, policies, various tools, which set up the overall environment. So you have, risk is inherent to every business, whether it's financial or non-financial, or the industry you are in, whether that's financial or non-financial, you have various types of risks. The way things are done in developed countries, or based on my experience, what I've seen here, is that the processes and the procedures and the mentality is embedded in each and everything, and in in employees or in companies' day-to-day business. So the conduct is the main part of that. And as I initially mentioned, the culture of managing risk is the most important thing. Within that, you have various components. And that's, for example, as I've mentioned, risk framework is a collection of various tools and procedures and policies, or the means through which you manage the risk that the legal entity faces. Within that, you have various risk management approaches. And approach covers your risk appetite statement. So you have got a risk appetite. The company has an appetite of taking risk, and you have a clear plan around that. And there is a clarity around how it's managed. So you have got limits set up, you have got the monitoring of those limits, and then reporting of any breaches and any management actions. So that's one of the significant aspect of the risk management approach. And then the body of the risk management is, as you can imagine, are the risk management processes. So legal entity or a company has a particular type of business, it works in a particular industry, that industry has some risks attached to it. The legal entity or company's operations or businesses exposes the company to certain type of risks. Those risks needs to be identified as major risks or key risks, whatever you like to refer to that as. And we will look into it in quite detail over the course of my presentation over next half an hour or so. The couple other aspects are indeed the governance around the risk management, and as well as the reporting of the risk management as well. So this sets up a tone of the risk management of a legal entity. Then moving on, we will look at the regulatory requirement side of the things. That is on its own a quite detailed topic, as you can understand, especially over last 13, 14 years since the financial crisis of 2007-8, with Basel III's implementation and further enhancements in that. That's a huge topic. But I will give you a flavor of what do regulators think around the risk management side of the things, and how do they implement those on day-to-day basis. So with that, Owais, if you please move on to the next slide, we will go in more detail on the risk management approach. The slide before this one, please. Sorry, yeah, no, you're right. Sorry, it's a bit slow at my end. Great, thank you. So the one fundamental part of the risk management approach is the risk appetite. As I mentioned, that risk is inherent no matter what you do. There is a certain type of risks involved in the activities. So based on a company's activities, it exposes itself to numerous risks. The fundamental tool to manage those risks is risk appetite statement. Risk appetite statement, as it alludes to, explains the willingness of the company of how much risk the company is going to take. So the overall risk capacity, you can say it, or the amount of capital or earnings or liquidity a company is willing to put at risk. However, that has to be linked with its strategic plan, its business objective and business plans, and so on. So you need to consider what legal entities or the company's plan is over, let's say, 5 to 10 years period, and short term compared to 5 or 10 years as well. And for that, they need to devise a strategy. They need to have companies have a plan. And the way things are done in Europe, or the companies that I deal with or look after, the risk appetite statement, there is a very close link between risk teams and the business teams. Now, what I mean, we will look in further detail on 3 lines of defense. But what I mean by risk teams and the business is, you have got within a company, you have got a team which is driving the business, which is bringing the new clients, let's say. So they are selling the products, whether the financial, non-financial. So they are promoting the business, and dealing with the customers and clients. So they are the face of the business, face of the company. So they are on the front line. The team or the heads of the frontline units or the business side of things, they devise a plan as to what is company looking to achieve over XYZ number of years. So what is the short-term plan? How will we achieve that? And what is the long-term plan? Now, on the other hand, they work with the risk management teams from the risk appetite point of view to look at the business as to how much room, how much leg room do we have to stretch our potential. Because one of the significant thing in setting the risk appetite is looking at your skills and in other way, the strengths and weaknesses as well. So we can push. Of course, everyone wants to improve the business, but you need to be practical and realistic based on what are our strengths and where do we lack the strengths or the weaknesses, and devise the appetite based on that. So that's where the two-way where communication involved between first line and the second line of defense, which I will touch upon in a little bit more detail later on. And one of the things it provides is a clear indication to the management at every level, including employees, as to what our activities will include and how much or how far can we go. Now, what I mean by that is this nicely links to the limits. So, for example, in financial sector, you are looking to increase your credit books. You go out in the market and you're, relaxed about loans or looking to increase your loan book. When you do that, you will have a set of rules from limits point of view as to a particular sector, we cannot go more than XYZ% of our capital or of our earnings or of our total assets, or certain type of size of the businesses you will look into it. Geographical basis as well, that within this region, we don't want to cause concentration in a particular region or particular country. And that's all defined through limits. Now it depends. You have market risks, you have credit risk, you have liquidity risk, and so on and so forth. For those particular type of risks, there will be certain business plan and there will be certain limits against those plans. And that's all covered within the risk appetite. And those limits are then monitored by the relevant teams. You will have a, let's say, salesperson, if I could say in simplest way, a person who's the face of the business, who's driving the business. And then you have team or the back office or the support team, which is sitting and keeping an eye on the application of those limits from the viewpoint that we stick or we remain within our risk appetite, which is linked with the business plan and the strategy. So we have a balanced approach, basically. And those limits are then reported to the management on a day-to-day basis. There could be triggers of the limits or the breaches indeed, and they needs to be reported. Limits could be management body owned, or they could be set by the board of directors of the company, and they will have a respective reporting in case of any triggers or breaches. So to give you a simple example, a very plain example, you have got some receivables sending and they have gone past due compared to your company's policy, and company has set up for from credit limits point of view that our past due should not be a certain percentage of our total receivable, and you breach that limit. So it could be a 3% is the past due limit, and trigger will be 2.5%. So when it hits a trigger, that needs to be reported. Even though you haven't breached the limit of 3%, but you have triggered, you have highlighted, it needs to be flagged up that we are approaching very close to our limit of past due risk appetite limit. And it will then be reported to management of the credit risk and the respective line of business at the front office. And depending who owns the limit, whether it's the management committee who owns the limit, or they have set the limit, or whether the board has set the limit, this trigger will be reported to the relevant committees. And there is whole governance behind it. The way I have seen it, there will be the journal things that you can imagine, the reasonings behind why the breach has happened or the trigger limit has been triggered, and what is the plan to bring it back into the acceptable level, basically. So that's kind of a quite fundamental part. The risk appetite statement is a fundamental part of the risk management approach. And generally, these statements get reviewed at least once a year. Now, this is, I must mention, normally this is a live document. So, and you can appreciate that if a particular situation change in the market or industry or the economy is moving in one to the other direction for some certain reasons, and we can nicely link that to the Brexit that happened at 31st December when UK or Britain has left the European Union. And over the last couple of years, there have been quite significant or specific limits or assessments going on, particularly from Brexit point of view. And also, as you're all aware, the latest pandemic that has hit the globe, and few businesses have been affected by it. So you've got the retail, the restaurant or hotel service industry, as well as the travel industry. So I know within our organization, there have been specific reviews or limits and monitoring around a specific type of businesses. So that is kind of a journal aspect you can understand or you can imagine. So from the retail business point of view, they will have to think, on the stock side of the things, how much orders they can place from the production point of view. When do they see the business opening, and when do they see, in fact, the sales to increase or have any sale or have any growth in the sale and things like that. And all that drives your appetite of risk. Where do you stand from the company point of view? So that's one of the fundamental aspects of risk management approach. Owais, if you please move on to the next slide. Thank you. The second aspect that we will look, and I'll spend maybe 10 minutes or so on this, is the most important part, is actually, in layman's term, is your day-to-day business, basically, how it's managed. So if you consider a business which is in a financial sector, you can consider some fundamental risks it faces. So you have got the market risk, credit risk, liquidity risk. One of the important risks that is given quite a lot of value in developed countries is the compliance and operational risk as well. The biggest teams on the risk side that I have observed in banks is the compliance and operational, because due to the nature of it, you can have operational risk in any type of team. So you have got different teams who deal in different type of businesses and providing various type of products. So you have got the securities business, you have got equities your company deals with, the funds or structured products or FX, and so on and so forth. Now, each of those have particular regulatory requirement. So you need to check that the relevant team is compliant with the regulatory requirement. So the compliance aspect is fundamental in that. And operational risk comes wherever you have any kind of operations involved in any team. And that could be related to the conduct risk as well. So the compliance and operational risk, it's quite big in developed countries based on my experience. And based considering that there is a huge appetite around specialists on compliance and operational risk side. And then apart from the standard financial risk side of the things, such as the credit risk, market risk, or the liquidity, you have got the strategic risk as well as reputational damage or brand damage, and that side of this, the non-financial risks as well. So the whole, the reason of all this preface or by this initial introduction, is that legal entity or a company has to identify the major risks that it's exposed to based on its business and operation. Because if you have a particular type of business, will have a particular risks attached to it. So you need to identify those based on your business. And within that, a fundamental aspect is the management of those risks. And for that, you will have various processes. So from market risk side of the things, you have got various models or monitorings that you need to do before any action is taken, so that the risk is managed appropriately. And within that, one of a significant part that is implemented in legal entities or in the companies here, and it is regulatory driven also, is risk identification. From regulations point of view, what regulators say that you will have material risk, you will have major risks attached to your legal entity or your company based on its operations, but you will have some other risks as well. So and they may fall in broader categories of the major risks. What I mean by that, within the market risk becomes your umbrella risk, one of the major risks. But within that, you will have particular individual subsections of market risk, interest rate side of the things, the pricing risks, and the forex, and so on and so forth. So what's regulators say, that you need to identify those risks as well. You need to maintain an inventory around those as well, and you need to consider how severe they can be based on your operation. So that is then considered on day-to-day basis, and there are particular cycles where the reviews are concluded and the inventory is updated. There are review and challenge processes, so audit is involved in that, in these sort of processes, to challenge, to question. And again, the different teams work together in the risk identification process. One of the great use of risk identification process is that indeed you use it as a tool from the risk management processes point of view, but it also feeds into your annual capital and liquidity analysis. So you may be aware that financial entities produces capital assessment, or the ICAP or the ILAP documents, as generally referred to. These risks that are identified under the risk identification process, which are the subcategories of the major risks, they then feed into your various stress testing and scenario analysis. And they then provide a capital assessment, and you end up with a financial number as a capital add-on as a result of the ICAP process. So, there is a qualitative impact and there is a quantitative impact as well. So you identify things based on the business, the way it's done, the processes, the procedures, and the risks you face, which could be both qualitative and quantitative, and they end up having an impact on your capital. So this is the link between how your day-to-day activities impact the actual financial position of the company. So we need to bear that in mind as well. And for that, overall, from processes point of view, companies need to set up the procedures around that. So I touched upon credit risk side of the things. Companies will have policies. If a new application comes in, we need to check the creditworthiness. We need to check the counterparty size, its concentration, and the geographical point of view, country risk, impact of the ratings of the counterparty, and the market sensitivity, what type of business it's working on. At the moment, one of the fundamental things going on in Europe, especially in UK, is around environment or climate risk side of the things. Early March, we had a meeting with regulators, and they are looking to produce a framework around climate risk side of the things to be introduced in the market going forward. But at the moment, they are doing some brainstorming sessions with various banks, some selected banks in the industry. So that's one of the things you need to consider, that what sort of business a potential client is involved in, what kind of impact it can have, or their business can have on environment or climate change. And ultimately it can have impact on the brand or the reputation of the company if we are involved with. And time to time we hear these sort of things, the BP or Shell, the oil leaks and the mining side of the thing. So all these sort of things are covered, are looked at in the risks teams that I've dealt with over my course of experience here. And then along the processes, we have already looked at the risk appetite side of the thing. So you will have the limits, you will have other tools such as the model side of the things, whether they are regulatory approved or the internals. And there will be constant reviews going on that side as well. So that's quite big side of the things on overall risk management point of view. And when I talked about major risks or the material risks and the risk identification process to keep your company's risk management live and ongoing process, you need to keep on identifying those risks. Next thing comes review and challenge process and the involvement of various teams. And this is in relation to 3 lines of defense. What we have in European markets is that you have got a clear segregation of roles and responsibilities and clear monitoring responsibilities between various teams. So you have got teams which run the business, which drive the business, look to bring the client, deal with the clients. They are the face of the business and the frontline unit, as they can be referred to, or line of businesses, or the front office, and you can refer to them in various ways, but they're basically the face of the company. And then you have got supporting teams, which is the second line of defense. It's basically the risk management team. They are separate and independent from your first line of defense. And what they do, they monitor the activities that the teams at the front or the business teams, they are undertaking. And their responsibilities are the review and monitoring of the requirements, if whether they have been followed by the relevant teams. And then you have got third line of defense, which reviews from back to front each and everything. So they are responsible for front office as well as the risk management teams as well. And this is your audit or corporate audit, who have the responsibility to review and perform the substantive testing of checking that the procedures are followed as they are. Both first line of defense and second line of defense are fulfilling their responsibilities as expected. So you've got front line of unit or business at the front, and you've got the risk management teams, and you have got audit. This provides a nice 3-layer management of risk. Each and every one of those have their own responsibilities, and the team behind them will perform the review to ensure that the team in front of me has performed their procedures as expected. The third part is more around the monitoring of the limits that we have already touched upon based on the risk appetite statement, or RAS. So that all fundamentally sits within your day-to-day management, where you have to identify your risks. You need to keep it live, consider any sub-risks within your major risks. It gets reviewed and challenged by various teams as part of the three line of defense. And you have to perform the monitoring, keep monitoring the requirements against the limits, and perform relevant reporting as required. So on that note, we can move on to the next slide. Thank you, Wes. This is mainly going to cover the bottom 2 aspects of the risk management approach. It's more around the risk governance and the risk reporting. So looking first at the risk governance, you can look at top to bottom or bottom top approach. I'll talk from day-to-day point of view, and then we'll look at the individual bullet points here. So as I mentioned initially, the risk management has a defined process. It's got its own components, or the way it's conducted or implemented on day-to-day basis. And there is a governance around it. Those procedures need to be reviewed on regular basis. Those limits needs to be reviewed on a regular basis. There has to be an accountability or ownership of those things. That's one of the interesting things. You need to have somebody who owns it and accountable, who is answerable to the management bodies and committees on the particular things they or he or she or the team looks after. So those things then ultimately gets reported to the relevant teams or committees, and ultimately to the board of directors of the company. And it gets reviewed through audit, and ultimately gets reviewed by relevant committees and the board as well. So if we look at individual thing, rather than looking at limit individually, if you look at the whole document where the risk appetite is set up, you will have different type of risks within there. You will have their own particular limits defined for individual risks, and they will be set based on your strategic plan and your objectives and what do you want to do and where you want to get over the course of a particular time. And they then get updated and they get reviewed and approved, and that's how they implement it. There are ongoing and individual teams or various committees as well, which look after these responsibilities on behalf of these committees that I've mentioned. So there may be committees within 3 lines of defense who have their own management committees, who, as I've mentioned, just above audit, you've got a management committee. So particular line of business, a particular second line of defense, or within the audit, you will have various committees who monitor their own operations, their works, and in case of any issues, they escalate or trigger the reporting to relevant committees. And those committees have the responsibilities delegated to them. So you have got such as audit committee or asset and liabilities management committee, ALM or ALCO, and various other committees who look after day-to-day operations and ultimately report into their respective committee, management committee, or it could be the audit committee. And ultimately, they report into the committees to which the board has delegated their responsibilities, and effectively board reviews and approve any question or provide the guidance where it is required. Ultimately, their responsibilities are delegated to the various other committees who look after the operations on their behalf. And as a custodian of welfare of the company, or to keep the company on course to meet its objective, board of directors look after it from above and delegate their responsibilities to various committees who in turn report into the board and keep an eye on the businesses on day-to-day basis. So that's the governance side of the things. Again, there are various regulatory requirements. Some of the basic things, as you can imagine, segregation of responsibilities and some delegated specific responsibilities for the senior managers. There are various regimes within the UK, the Bank of England's committee authority that requires the senior managers to take some certain actions. So that's all rolled into the management committees, who ultimately reports into the board committee and to the board, and it's covered through that. So that's quite kind of area of focus from regulator side at any given time during the year. So what regulator basically expect or want you to do is be smart around the governance side and try and have a watertight governance process within the legal entity, so that things are reviewed on time, they are challenged, where there are issues, they are reported on timely manners, so that management is able to take action in timely manners. So based on the past experiences and the crisis, there is quite a lot of focus on the governance side from various regulators as well at any given time of the year, just because of the nature of the businesses. And it goes very nicely hand to hand on the risk reporting side of the things as well. And again, as I've been saying, there are particular processes that are established as part of the risk management processes. They need to be monitored and reported, and there is governance around that. And the relevant committees, relevant management bodies, or the committees to which the management body has delegated their responsibilities, they go through all that process, but they need to be aware of what's happening as well. So to support that, reporting protocols are set up, again, these could be devised around both financial and non-financial, or qualitative and quantitative side of the things, because you need to consider that there aren't only financial risks that a legal entity considers or exposes itself to. There are non-financial risks as well, such as I mentioned, compliance side of the things, or operational side of the things, as well as your strategic plans. So you've got a strategic risk, as well as reputation or brand damage side of the things as well, which may be more qualitative in nature. However, as we have established on previous slide, effectively they can have impact on your or legal entity's capital as a result of the impact on the business. So and reporting again, it's to a process. Management has a responsibility to provide certain set of information to various committees and to the board, and board can request, or various committees can request, any additional or enhance or any ad hoc information as well. And to that point, I would spend maybe a minute or so around the COVID-19 side of the things. So what we have seen over the course of last year or so, various banks or financial sector being proactive. They had to kind of increase the frequency of the monitoring or the reporting that they have been doing, as well as from the regulator side as well. They have requested more information more frequently. So from the within France, within Dublin or Ireland, sorry, I should say, and UK as well, regulators have been having more frequent calls or discussions with various banks on regular basis. It was more so towards the start of the pandemic, the first half or the mid until mid last year, towards the end of last year, in fact, I should say. They have been quite intense and quite a bit enhanced reporting requirements from regulators. If there was a particular report was done on a monthly basis, it would have been gone on weekly basis. And there may have been some on and off calls on particular things for regulators, which normally would not be the case. So that's how regulators have reacted. The main purpose is that what is the stability or what's the financial position of the company, and if we hit any further crisis or the financial crisis, or what is the strength of company to deal with any particular impact as a result of this pandemic. So that's kind of it gives you an impression of how active or proactive you have to be, or companies are within the developed world when it comes to the risk management side of the things, with the changing economic or market scenario as a result of particular global events such as COVID-19. So that's a little bit more around some of the live examples of implementation or application of the governance and the risk reporting side of the things. And in the end, I'll just do a quick touch on regulation side of the things. Thank you, Wes. So within UK, you have the main monetary body is Prudential Regulatory Authority, which is a subcommittee or sub-body of Bank of England, and they set the rules or the requirements from regulatory reporting point of view for the legal entities or for the companies registered in the UK. And along with that, since we're talking about, I should have included here from the European coverage point of view as well, you have European Banking Authority or the European Commission. And European Banking Authority sets the requirements on behalf of the European Commission. So the things, if I break them down in, let's say, micro and macro point of view, within the UK, within the country, Bank of England, through PRA, sets the requirements, very close to what Basel III requirements are at the moment, looking towards going to the further enhancements. And they have particular requirements that needs to be fulfilled and submitted to PRA. Some of that information is then ultimately submitted to European Banking Authority on behalf of the companies in the UK, and you provide the information that way. And overall rules that are in place are driven by the European Banking Authority, which encompass Basel III requirement, and overall, both on that's more from macroeconomic point of view. So within the whole European region, the Basel III is implemented through the Capital Requirement Directive or the regulation CRD or CRR, and ultimately then the individual countries, they have their few small tweaks, few small changes based on their own microeconomic structure for that country, and ultimately all that common set of information feeds into the EBA or European Banking Authority from a reporting point of view. So the couple of reports that I've touched upon already, that's I've mentioned in the regulatory reporting. So there is a common set of reporting, common reporting, or core app as it normally referred to as, which is based on the Basel requirements, and that information is provided to the regulators. And then again, as I mentioned, each individual country may have, so within Germany, you have their own particular requirements. Similarly, in Spain and Turkey, their own local regulators may have some few additional bits and pieces on the top of what Basel Accord requires. So you have got an overarching Basel requirements, and then you've got individual country-wise requirements as well. I've dealt with the companies in a few countries, as I mentioned here, and each individual regulator behaves differently based on their experience with a particular kind of industry, and the requirements are driven based on this. So one regulator may be asking a little bit too many questions compared to the other regulators, but that's around the country's own dynamics and the business and regulators' requirements as they feel fit from their requirement point of view. And other side of the thing, along with the regulatory reporting, is the various risk reportings. And I mentioned earlier, you've got the capital assessments that needs to be conducted, liquidity assessments that needs to be conducted over the course of a year, and needs to be submitted to the regulators. Those informations are published on annual basis based on the size of the companies, globally systematic important banks or financial institutions, and so on and so forth. So various criteria, and the EBA or individual country regulators, they share the ratios or the high level information as a comparative across the various banks or companies. And same goes from the liquidity point of view as well. And regulators come in to perform their reviews and their evaluations, and commonly known as SRAP review. And they provide their feedback and ask companies to make any enhancements as they think, if they think there are any improvements needed. And then you have got, it goes without saying, various other reviews and reporting, whether they are planned on regular basis or ad hoc. That's always the case, going on and off. On this point, I will hold on here, and Owais, let you check if there are any question, or if you have any question, I'll be happy to answer.
Thank you, Sohail. I think it was a wonderful presentation. You have covered things pretty well. So if the participants have any questions, they can write in the text box. Until then, I have a couple of questions. The first one is regarding the last slides that we have. So basically, in Pakistan, we have ICAP only, the Internal Capital Adequacy Assessment Program, and liquidity is covered under this particular framework. So, do you have a separate regulation regarding, or how is it a sub part of ICAP?
Right. No, a separate document needs to be submitted on liquidity assessment. It is leveraged, or it's very closely linked from some aspects, from some components of that, such as when it comes to the risk management, your policies and procedures will remain the same. But you need to provide separate detailed document on the liquidity assessment side of the things. Yes, there is a separate document, guidelines or the requirements on the top of the ICAP, which needs to be considered to produce the liquidity assessment document.
Okay, then I have a question that what is the career progression or career choices in developing world for someone with an FRM certification? And are these certifications important to grow for someone with a career in risk?
Yeah, so I think in general, within the risk management, to enter into the risk management, you have to have a decent, a very good financial background. So the way I'll just cover this question in general to begin with, and then I'll go into the specifics. So the way I've noticed companies look to hire employees within the risk management are two, and these are the two ways. One way is pretty straightforward, where a student completes their qualification or their education, so generally high school or graduation, and they join the associate program, and they progress over the course of time based on that. The other way is you have a, let's say, accountancy qualification or the risk management qualification and experience, and you are hired on that basis. So the progression aspects are, I would say, you have FRM is a relevant qualification. The aspects are very good. The options are very good. It all depends on, based on your experience, what can you do? So it's very positive qualification, and it has a good progression options based on FRM as well. I didn't get the second part of the question.
That was the question related that are these certification important to grow in career in risk or not? Or PRM, let's say.
Yeah. So again, I think these are good to enter in the risk management. Indeed. Afterwards, it's all about what can you do, how much you can take on, what's your relation with various teams, what's your networking with the senior management, how active you are in your response. It depends on your caliber. Yes, they do add value, but from progression point of view, once you are in the field, then there are various other things that count in it. So, what sort of work you are taking on, and what sort of, the quality of your work. So, you can say the journal things, but once you are in, it depends on you. That would be my answer.
Okay, thank you. The other question is there any additional ratios for liquidity for banks in the UK other than LCR and NSFR?
Yeah, so interesting question. So yes, there are matrix that regulators require. There are a couple matrix reporting that have come in the market over the course of last 3 years or so on the top of LCR and NSFR. But they are closely linked with LCR and NSFR. So again, driving regulation is Basel. However, individual regulators have asked that provide me XYZ information as well for me to be able to look at your liquidity matrix. So what I mean by that, for LCR point of view, PRA has gone into the maturity buckets as well. So you provide me the information, but I need the individual timeline as well based on your products and based on the maturity as well. So the driving ratios are the same, but the type of reports under it is quite diverse.
Okay, so we have another question. Is FRM qualification really well accepted in credit management, not in traditional risk management back office job?
Well, it is a recognized qualification. FRM is international qualification. It is indeed recognized. Yes, it is. You will be given opportunity. If you have somebody who has got just the accountancy qualification and you've got a specific risk related and both going for a credit management or credit related role, the FRM one will be considered a little bit more relevant, and then it would be based on the experience you have. So yes, it is a positive qualification to have from credit management point of view as well.
Okay, Sohail, I think this was good. We have been able to answer the queries. Thank you so much again. It was a very good session. I myself learned a lot of things. So thank you so much for time out, and we look forward to inviting you again for some other more specific topics.
Absolutely, it's been a pleasure. Thank you.
Thank you everyone for joining in. The session will be uploaded on our YouTube channel, Mastering FRM, so you can access the slides there. I will try to share the slides as well with the participant with the permission of Mrs. Sohail. So, okay, thank you so much. So we'll be signing off from today's webinar. Hope you had a good session, and we look forward to seeing you again. Thank you. Allah Hafiz.